Hope everyone's doing well. And I apologize for the background noise today, but it won't be forever. So if we start with the daily chart, tight bull channel, first reversal down, probably going to fail. There's your first reversal. Here's your second reversal signal bar. It's got a bull close. It's a doji bar. We don't have a significant trend line break, so as far as shorting here, I would not. Some bulls might get out of longs, but I don't think this micro double top is enough to undo this rally. The bears probably need a trendline break first, then a retest of the highs before there's any chance of a major trend reversal. So what we have here is a low 2 short signal bar, but in a tight bull channel, so bad context. So remember that the daily chart, sorry, I'll fix that. This is the signal bar in the daily chart. The reversal bar closing below its midpoint, but closed a bull bar. And if you remember the context on the daily chart, we have a tight bull channel and a second reversal, but weak signal bars, small signal bars, not enough to undo the damage by the bulls. And then here's the bar. Here's this reversal bar on the 5-minute chart. So big up, big down. We're low in the range on bar 1. Do you really want to sell below this bar, even though it's a low 2? Do you really want to sell below, really at the bottom of a trading range? Maybe the high of the trading range is up here, and around here is the bottom. This red line is yesterday's low. So you can see what happened on bar 1 today. Bar 1 opened just above yesterday's low, sold off, trying to break out below the low of yesterday, and it triggered that low 2 signal bar. And the bears were hoping that we'd get a strong breakout, get a bar like 48, but closing on its low. Instead, we reversed up on bar 1. Bar 1 became a double bottom with 56 yesterday. It's a lower low, double bottom. And part of the problem with buying above bar 1, it's a big bar, so big risk. And there's a prominent upper tail, and that is a warning that traders were selling into the close of the bar. So if this was so bullish, why are traders selling into the close of a bar? Also, the gap down can be thought of as a bear bar. And even though the context is bad for a bear breakout, this is enough down that there will probably be some sort of second leg. And if there's going to be some second leg, this could simply be a pullback before the second leg. So bulls probably thinking they can buy lower, bears thinking they can sell on maybe on a limit order, looking for a pullback and then a second leg. Maybe they sell at 50% of this leg down, which is this red line. Bar 2, we have a doji, so bad follow through for the bulls. We did trigger the buy above 1. Actually, that might be... Sorry about that. We actually did not trigger the buy, so we have an inside bar, and that lowers the probability for really both sides. Any breakout of an inside bar are trading range bars. So if you get a breakout of an inside bar, you know the odds are we're going to pull back fairly soon. Bar 2 is also a low 1 short at the bottom of a trading range. So for a couple of reasons, you know the odds are there are buyers below and probably sellers above. Bar 3 is a bull bar closing on its high. But look at the overlap with bars 1 and 2. More than half this bar overlaps with the prior bars. That's a warning that you're in a trading range rather than a strong breakout. Plus, even if bar 3 was completely above the highs of bars 1 and 2, you're still within this trading range here. Traders might call this a triangle, whatever you call it. It's breakout mode. We've got a bear breakout, and bad follow through, bar 1. So the market might be racing to this apex, the apex of this triangle. Bar 3, also a low 1 short signal bar, probably buyers below. And then bar 4, we fell below bar 3, and there were buyers below. But the buyers are scalping. They know that the first 4 bars are totally overlapping each other. Bar 4 became a reversal bar. So it's a bear close, but it's closing above its midpoint. So it's actually a buy reversal bar, and we're in the lower third of an overall trading range. But do bulls really want to buy above a bar like bar 4 with all the overlap and the bear close? Probably not. There are probably more sellers above, and the bears still think this was a decent enough breakout that we'll at least come back and test the open of the day, which would be the close of the theoretical breakout, the gap. Inside bar on 5, so another bar like bar 2, reduces the probability for breakouts. Even if we trade above, we'll probably pull back. Plus, it's 2 legs up for the bulls, and we may come back and test down lower. We know it's a trading range with all the overlap, and trading ranges test breakout points, and there was a breakout from, we see the open of the day, but again, if the gap down was a bear breakout, the close of that breakout bar is a magnet. Another inside bar on 6, so II pattern. Consecutive inside bars, the market's getting squeezed. It's breakout mode. Like I keep saying, breakout mode, it's a trading range. It's a very tight range. Usually better to wait for a breakout or wait for more information if things are confusing. Bull breakout 7, but traders know any breakout of a triangle has a 50% chance of failing and reversing. Plus, apex of triangles, this area, is going to be a magnet. So bar 7 looks like a decent breakout, but why is there a tail on top, even though it's small? And why are we stalling at the moving average? Bears see 1 leg up, maybe a couple legs down, pull back, and then a second leg up. And again, if it's maybe a 50% correction, it's probably a little deeper. We're at about 60% of this bear leg. So we're going to have resistance here. You also had this triangle trend line, and we're testing that as well. Inside bar on bar 8, again reducing the probability for breakouts. It's a high one, but it's not in a strong breakout. The best case for the bulls here, we're in a bull channel. And what do we know about bull channels? 25% chance you get a breakout above the channel line, which is this upper line. More likely, we reverse down and test the trend line, and we may even come back and test the low of yesterday once again. Outside bar 9, so we went above the high one, we went below. It's a really neutral bar. The bulls are doing something. The bulls are preventing the bears from getting a close. So we had a bull breakout and then another couple of bull bars. But the problem, bar 9 testing the high of bar 6. So any bear who sold above bar 6, whether or not they scaled in higher, they were able to exit at their first entry price. So again, with an inside bar and an outside bar, the market's in breakout mode. It's an expanding triangle on a smaller time frame, probably sellers above and buyers below. Another inside bar, so IOI, that's also breakout mode pattern. It's a trading range on a smaller time frame. And we're in a bull channel, but bull channel means bear flag, so slightly higher probability of the bear breakout. Another inside bar on 11, so the market's obviously really tight here. We had an inside bar, we had an inside here, inside bar here, a couple more here. The market's very sideways. So is this a strong bull trend that you're really eager to get into? Are you feeling this sense of urgency that you may have felt over here? Where the market's moving in one direction really quickly with little overlap, consecutive bull trend bars closing on near their highs, And for several other reasons, you can see this is clearly stronger than what we're looking at right now today. We have a lot of overlapping bars. We're getting bars with small bodies and big tails. And that combined with the overlap, sure, we're going up, but it's obviously a channel. So it could be bear breakout, complex pullback, maybe 2 or 3 legs up before a second leg down. The risk is real that we can come back down and test here because it's a channel, and channels evolve into trading ranges. Bull breakout 12. So the market often tries to do something drastic on bar 12. Not that this is drastic, but obviously from the 5-minute chart to the 60-minute chart, bar 12 corresponds to the close of the 60-minute bar. And you can see here, the bulls got the bar to close on its high. I apologize if the video seems choppy with the way I'm talking because of that noise outside. Somebody's doing work outside, and I keep having to pause the video, and sometimes it's for a couple minutes at a time, and I forget where I was. And so I just wanted to say that. So again, bar 12, 60-minute bar closing on its high. So even though it's consecutive bull bars, the first bar was an inside bar. So really bar 12 is the only breakout bar. And what's it breaking out of? It's hardly breaking out of the channel, really. It's a parabolic wedge. You can call it a parabolic wedge. You can call it a channel, but the problem is that it's 3 legs up. And leg 3 is the lowest probability for getting a second leg when you get a breakout. So bar 12, bulls need to do more here. That's my point. And there might be more sellers above. And then instead we got a bull breakout on 13. So decent for the bulls, right? Bull breakout and follow through. But look where we are. I drew that triangle earlier. And the market could simply be testing the highs of a trading range. Really, it's a triangle. So possible buy vacuum test of resistance and a breakout of a channel. And that's a 25% chance we accelerate to the upside here. So some traders will sell bars like 13, and they'll bet that we won't get a measured move up to here. So they might put a stop a little bit above this price, and they'll sell, betting that we'll close the gap. Whether it's the high of bar 9 gap, and then there's a gap above bars 11 or 10 and 11. But 3 consecutive bull bars can be hard to sell. Another bull bar, 14, closing above its midpoint but big tail above, breaking out of the triangle, and that's good for the bulls. So this is a fairly strong rally, possibly a leg count reset. I said it was leg 3, but now the bull bodies, they're getting bigger. There's little overlap. Traders are getting trapped if they sold above bar 9. Where did bears have a chance to make money? So if a bear can't make money selling above a bar, that's a warning that there's trapped traders. And trapped traders are fuel. So the bulls know bears are trapped. There's also bulls that are trapped. A bull may not have bought because they said might be a third leg. I don't know, we're breaking out of a channel. There's resistance right here. And then we get this. Now this is strong enough for a second leg because there are trapped traders below. The bulls who didn't buy want to get long. And that price that traders are looking for might be the bar 9 high. It's a breakout point. The market broke out above this high. We're up here. Traders will look to buy lower for a second leg up. But keep in mind all the trading range price action we've had on the open. So the odds of this being a bull trend day still are not. The bulls need to do more. The odds of a bull trend day might be 40%. Maybe slightly higher. I don't know. I think a bull trading range day is the highest probability at this point. And because of the rally, a bear trend is the least likely. So as far as selling for swings, I would be careful doing that. But keep in mind, 50% chance the first move on the open is the wrong way. So this could easily be a parabolic wedge early high of the day, and then we reversed down. But because of the context on the daily chart and the fact that we went below the low of yesterday on bar 1 and then immediately reversed up in this tight channel, I think that lowers the probability of a bear trend day as well. So what do you do here? This is the first bar breaking above the triangle. So this is a bull breakout with a prominent tail. And now traders want to see follow through. It might be by the close, but I think the context is bad, really. The market's really sideways here. As strong as this looks, the reality is that this is probably a leg in a trading range. And gaps within legs and trading ranges tend to close. And that's why I drew this red line here. So again, some traders will sell, betting this is climactic and unsustainable, and that we will reverse fairly soon. Other traders are buying, looking for that measured move up to here, maybe targets up here. Disappointing bar on 15, so bull breakout, but then disappointment. 15 is a high 1. And we know that there's probably sellers above 15 because it's a disappointment bar. Bulls who bought, they'll take any profit they can get and look to buy lower, like maybe after 10 bars and a couple legs sideways to down. Reversal bar on 16, so a bull bar closing on its high, but this is a high 1 signal bar. And we know that there's probably sellers above. It's actually a 3-bar micro channel as well. You can see each bar's high is lower than the prior bar's high since here. So probably sellers above 16 and a deeper pullback likely. But the bulls, they get a bull breakout, maybe a breakout pullback testing this trend line, and they're hoping that we rally strongly on the high 1. And you can see the high 1 didn't even trigger. So we had sellers above that didn't get triggered. The stop order above 16 did not get triggered, and bears are forced to chase the market down. And 17 closes as a strong bear bar. It's a second reversal down. We went below 15, and we're going down again on 17. This time a strong bear bar. Now what's more likely? From the current price, is it more likely we close the gap or come up here? Because bulls just exited their longs, they're not interested in buying for probably a couple legs sideways to down. And like I said, gaps in trading ranges tend to close. So I think we're probably going lower. Reversal bar on 18 is a high 2. Technically a high 1 on this chart because there's no stop order trigger since bar 14 went above 13. So a couple legs down for the bulls. The bulls looking to buy, maybe a high 2 and a bull trend. But does this look like a bull trend or does it look like a trading range? The problem I have with buying a high 2 high in the range is that you're buying high in a trading range. You can buy high 2s near the high of the range, near the high of the day, when it's a strong bull trend. And all these bars to the left are way below the bars here. But because there's all this overlap, the odds are there's sellers above these highs. This is resistance. This is strong enough up for a second leg, and we may get a small second leg here. I think more likely, if we do go to a new high, we'll probably find sellers and have a deeper pullback. We triggered the high 1 on 19. You can call it a high 1 or a high 2, really. It's going to function the same way. And if you bought above 18, how do you feel about your entry bar? It's disappointing. We've had all overlapping bars since 14. And if we go sideways for 5 bars, that's enough that traders will start to wonder, are we really in a bull channel? Are we really in a bull trend? Or is it more of a trading range? And that will increase the sellers above. Even if it is a bull channel, you have traders buying below bars and taking profits above. So if we do go higher, there's probably sellers waiting. Small bear bar on 20, triggering the low 2. So it's a second reversal down on 15, and then down below 19. But a weak sell signal bar, 19. It's a low probability trade. If you sell below 19, stop above 19, or stop above 14, which would be a better stop in this case, because you have the risk that we'll go above 19 and then reverse down. But going sideways, and after a bull breakout, the bulls know this will probably get a second leg. 21, a bull reversal bar, high 2, high 3, pull back to the moving average. It's tricky because it looks like it's a bull breakout, then a triangle, which is a bull flag in this case, and then a decent buy signal bar. It's only one tick. It's a one tick bull body, which obviously could be stronger, but it's a reversal bar, and there might be stop order traders buying here. But the risk that they face here is that we are high in a trading range, and you're buying a high 2 or a high 3, high in a range. And we might rally for a scalp, but I still think more likely there are sellers waiting above. Bull breakout 22, that's good for the bulls, but why couldn't they close above the high of the day, bar 14? You can see we broke out, but we didn't close above, and it could be a vacuum test of resistance. Traders knew a second leg was likely, and if you know a second leg is likely, if you're a bear and you know the bulls are probably going to get a second leg, why would you sell above bar 21 if you think we're going up here? And when traders are thinking that way, you have bulls buying, knowing we'll probably go a little higher. You have bears waiting to sell higher because they also think we're going a little higher. That creates an imbalance, and price has to go up to find sellers. 22 closed below this breakout point, and that's weaker for the bulls. The tail on top is also weak, and it totally overlaps all these bars. So these are all characteristics of trading ranges and channels, so buying high is not a good idea. Follow through 23, but possible second leg 1, pullback, leg 2, high in a trading range. It's a tight bull channel, always in long, but the problem for buying up here, again, the tail on 22, traders will say it's a wedge. There's resistance up here, and I will say the bulls, they have an open gap from the bar 3 close to the bar 10 close. It's a body gap. So on the line chart, this is a gap. And then you can see there's another gap here with these bodies. And that's good for the bulls, a couple open gaps. The bears, not much selling pressure today. That reduces the probability, again, that we'll get a bear trend. But I still think the bulls could be a lot stronger. Why are their tails above bars? Why are we going sideways for so many bars? We're getting bull breakouts in between, but they might be buy climaxes testing high in a trading range. Some traders will see this as 3 legs up to bar 9, up to bar 14, and then up here. The bulls are hoping it's a double bottom neckline breakout here, and we go to this measured move. But if we do go to that measured move, the bulls need to keep getting bull bars. The more we go sideways or we get bear bars, the more disappointing the follow through, the less likely we'll get there. And then look at 24. Bear bar closing on its low. For the bulls, if you were long, probably wise to get out below 24, a bear bar closing on its low. Whenever you're long, even if it's always in long, and you get a bear bar closing on its low against you, most of the time it's okay to exit your position, and then you can look to buy again above a bull bar closing above its midpoint. The problem with holding long here is that 24 is a credible stop order trade. It doesn't mean it's high probability, but we had a reversal here, which was a trend line break. This was a tight channel. We went sideways, We got a possible higher high, major trend reversal, and then a bear bar closing on its low. Bull breakout, the first bar to close above here, so we're finally breaking out, but where's the follow through? 24 reversed down fairly strongly. Now the bears still don't have a lot of selling pressure, so do I think we're going to sell off to the low of yesterday? Probably not. On some higher time frame, this entire channel up for the bulls is simply a breakout. Plus we had the open gaps, so we know that this was strong enough for a second leg. And when you have a major pattern like this, it's going to take more bars, so the correction could last up to several hours before we rally for that second leg, which could come later in the day. But obviously, if you look at this, if you looked at today alone, without looking at yesterday's context, you would say it's a bull trend. Follow through selling on 25, that's the problem with holding long below 24. You get a bear bar closing on its low, traders are willing to sell. Possible early high of the day, the bears need to do more because 24 and 25 are good bear bars, but they're not far above average in size, and they're both pretty much completely above the moving average. The bulls were able to control price above the moving average for about 10 bars, and that's pretty strong. So big up, big down, probably a trading range here. We might be getting low in that range, but this was strong enough that it's probably a leg one, and any pullback will lead to a second leg. Inside bar 26, probably the start of a pullback, probably sellers above. And then 27, we fell lower. This could all be one leg. It's a micro channel, no bar traded above the prior bar's high since bar 23. So probably sellers above the micro channel. 27 is a buy reversal bar, but you're probably high in a trading range. And the bar closed with a bear body. That lowers the probability for buying with a stop. And a bad stop order trade is a good limit order trade. Inside bar 28, that's another bad stop order trade, probably sellers above. It's a small signal bar. We might go for a measured move up or down of the signal bar. Well, we will, but it's possible we rally and then come back lower. Possible that we know it's a nested two legs, but we also know it's tight enough that this entire move, this micro channel, is one leg. Any pullback will probably get a second leg. But because it's leg one, pause, possible leg two, some bears are going to be looking to sell higher. Another sell climax, 29. So now we have 3 pushes down. It's still tight enough that it's all one leg, but it is 3 pushes down. It's a minor pattern. You can call it a parabolic wedge. The reality is we'll probably get a correction, and it's because it's only about 6 bars that we won't get 10 bars in 2 legs. Well, probably not. More likely it's just a couple bars for a correction, and then we'll come lower again. Probably sellers above 29. It's a big bar. It's another buy reversal bar, but another bear body. One bull bar since maybe the past 6 bars. So another bad stop order, good limit order trade. But the sellers may not come in until somewhere up here. You had bulls buying below 23, betting this was strong enough for a second leg, and they got trapped. And buying below that bar was a reasonable thing to do. And whenever you do something reasonable, there's a 60% chance you can scale in and exit at your original entry price. There's an 80% chance you can scale in and exit the entire trade at break even, which would be your average price, the midpoint between your 2 entries. This gap, we finally tested it here. The gap is still open, but it's weaker now because bears, if they sold here, scaled in higher, they had a chance to get out. It was brief, but they could have had limit orders here, and they did have limit orders here. Inside bar on 30. It's an inside bar, so it lowers the probability for a breakout. Tight enough bear channel, still a micro channel. You know the odds are there's sellers above. But at this point, most micro channels last between 3 and 7 bars. So the more bars that get added after 7 bars, the more extreme it becomes, the more unsustainable it becomes. And eventually, reversals, even if they're minor, like a pullback, becomes more likely than resumption down. And now we're at about 7 bars down. 31, it's a bear bar. It's a micro double bottom with 29. But again, it's still a micro channel, so the odds are there are sellers above. Unfortunately, I need to speed this up a little. The micro channel continues. The more bars that get added, the more likely a pullback comes. And then a little bit of a surprise, 33. I actually saw this in it was an Al Brooks trading room. It was like a sample on YouTube. And he made an analogy that actually made a lot of sense to me, and I wanted to share it here again. So again, this is Al's idea. And what he was saying was, when you get a micro channel like this, but the context isn't great, you're in the middle of a trading range where you know the first leg, the bull leg, was strong enough for a second leg. And then you might be at the midpoint of that leg. The point is the context is bad to be selling. So if the market isn't just selling off and going your way quickly, you're trying to get more overlap. We had a trend line break here on bar 29. The tail on 29 is a trend line break on a smaller time frame. And then you get that. So we have 3 legs down, then a pullback here, second leg down. The point I'm making here is that the context is bad. So when you have a micro channel getting over 7 bars, the context is bad. Traders are basically, it's like they're playing musical chairs. And nobody wants to get caught selling at the bottom and then get trapped. And that's what happens on 33 right here. And the reality is this is strong enough that this is probably a minor reversal. And the market will probably get a second leg down. But 33, enough of a surprise that it might get its own second leg because markets are fractal. Follow through, 34, crossing the moving average, but pretty much half the bar is still below the moving average on 34. And there's tails above, so we have sellers into the close of the bars after a micro channel, which should get a second leg. This is a minor reversal, but probably buyers below 34. And you can see we fell below 34, buyers below. Now the second leg for the bulls here could be really small. We could trade above 36 briefly and then reverse back down because this is a minor reversal. And trading a second leg in a minor reversal is dangerous. And that's exactly what happened on 37. Bull breakout, pullback below 34, there's buyers. And then the low of 36 to the high of 37 is the bull's second leg. This bar tested the high close over here. Bulls are satisfied. They were sufficiently disappointed with this pullback. They said, forget this trade. I'm just going to exit at this close. And that's what happened on 37. Now 37 is a second reversal down. Low 2 at the moving average after a strong micro channel. If you're long, I'd get out below this bear bar closing on its low. Now 38, not the best entry bar for the bears, but also not a good buy. So probably have to go lower to find buyers. Outside down 39, possible double bottom, but higher low double bottom, but doji signal bar, and bear bars. Probably going at least a little lower. Bull inside bar, 40, inside bar just below the moving average. Do you really want to buy an inside bar at resistance? Probably not. Almost outside down. Really a reversal bar, 41, probably going lower, but now it's a low 1 at the bottom of a range. But I still think this was strong enough. This probably was not the second leg the bears are going to get here. This could be the completion of this leg on a higher time frame. We were down here, we came back down here. This could all be just one leg. We may have to come lower. 42, trying to break below this neckline. The bears want a measured move down, maybe test yesterday's low again. 42 is a bad stop order trade, probably sellers above. 43 is the same. Bull bar 44, but small, in the middle of a range, probably sellers above. And then 45, a little bit of a surprise. Sellers on the close of 44. We fell quickly, but look at all the overlap and all the breakout attempts by the bears are of this channel, and they're repeatedly failing. Now this could be leg 1, pullback, leg 2, and leg 2 is a lot weaker than leg 1. Plus, if you compare this leg 1 to this leg 1, obviously this one's bigger and stronger. This one had dojis, more overlapping bars, but this one also covered a lot more distance. So possible 50% pullback for the bulls. We rally, pull back a couple legs. The bulls are hoping we rally for the second half of the day and get maybe a symmetrical second leg. So bulls looking for a midday reversal here, but no signal bar to buy on a stop yet. Inside bar 46, probably buyers below. 47, low 1 triggered, and again probably buyers below. You can see we're above the 60 moving average, the 60-minute chart. And even though we're above, below, really overlapping with the 5-minute EMA. And that tells you we're in a trading range. But the regime, the market is a little more bullish. That's what the 60-minute moving average is hinting at. Every time we get to it, there's buyers. We dip below it, there's buyers. We try to test it again, there's buyers. 48, that's your bar for the stop orders. So what do I mean by that? Most bottoms, major reversals, in this case a bottom, have credible stop orders. What the bulls have going for them here is it's a bull bar closing on its high, closing above the moving average, and the context is good. Decent rally here, complex pullback, leg 1, and then the second leg was a nested wedge. And then 48 is a bull bar closing on its high. It's not yet high probability, so the bulls still a low probability trade, but I would certainly get out of shorts above 48. The risk is real that we get leg 1, pullback, leg 2 up to here, and I will draw that so we can erase this. I just want to add a text box as well, just so we remember what that is. Bad follow through on 49, but there's an open gap. 49 created a gap from the high of 47 and the low of 49. Could be stronger because both bars on either side of the gap are bear bars, but the context is still good for the bulls. We have a wedge down, nested 2 legs after a decent leg up that should still get a second leg. Here's your pullback and possible major trend reversal. This was a tight bear channel. We had a trend line break and then a retest, and the retest was a wedge, like I said. And then more buying, 50, 51, bull breakout and follow through. The bulls who bought below 23, they were able to exit at break even. Now this is strong enough, even though it's leg 1, pause, leg 2. It's a nested 2 legs, but really you can look at it as one strong leg. The reality is we're probably going to get a second leg after this, even if we pull back first, which most of the time we do. 52, disappointing bar, so we might have to go lower. Bulls who bought 51, disappointed with 52. Bull bar 53. We're getting close to the high of the day, which is a magnet, and we may have to get there before we pull back. The problem for the bulls here, looking for this leg 1, leg 2, is that this was enough down, then this is enough sideways, and now we're getting a wedge. So the odds are there's sellers at the high of the day and will at least stall, if not pull back or reverse. What the bulls do have going for them is that this is a parabolic wedge. Parabolic wedges get minor reversals because they're breakouts on higher time frames. This is all a micro channel. The odds are there's buyers below. We tested the high of the day on bar 54, but this is not an ideal place to buy, even if you're swinging for the leg 2 measured move. There's a couple reasons for bulls to take profits here. And if you get a bear bar closing below its midpoint, I'd get out of longs, and that's what happened on 55. The bulls know it's not ideal to be buying up here, and so they know that they will probably get a chance to buy lower. Maybe this was the start of the channel. We went sideways on bar 52. That's a magnet, and we're testing it right away on 55, so we might bounce there. But 55 was enough disappointment for the bulls that any rally we do get, maybe to test the 54 close, should be met with selling. We rallied on 56. It's an inside bar. Bulls trying to get to that price, and they get close on 57 before exiting. Now these are all overlapping bars, 2 legs down. The odds are there's buyers below. Low 1, but bad context for the bears when it's completely above the moving average after a strong breakout. But it is within a trading range. So now we have a trend line break. The bears hoping we get a retest of the highs and then a major trend reversal. 3 consecutive bear bars, but again, a lot of overlap. Could be a wedge. 1, 2, 3. 60, we're still above the moving average. So we have several bear bars and a micro channel, but it could be leg 1, pullback, leg 2, and leg 2 subdivided. 57 low to 58 high. That was a trend line break on a smaller time frame. That separates 2 legs. So it's a nested 2 legs. So bulls might be looking to buy here. We went quickly through the moving average. So the moving average is support. And that's what happened on 61. The bulls bought. Not an ideal bar to buy above 60. And 61 has a tail. But when you're trading with the trend, the entries never look ideal. Pullback on 62. It's a bear breakout, but just barely below the support, the moving average, and all the bars to the left. The bears really need follow through if you consider that the breakout. And then 63, a smaller bar with a tail. Leg 1, leg 2, leg 3, testing maybe 50% of this leg. Not ideal to be selling here, and bulls will buy for a scalp or for a swing. Bull bar 64, that's another credible bar, like 48, that the bears need to respect. It's an always in flip. I don't think we ever went always in short. But if we did, 64 is the bar to get out of shorts above. I think both bulls and bears will buy above 64. And then 65, weak entry bar, but bad low 1, probably buyers below, if we even trigger it. 66 continued higher. Bears know if they sold 63, they might be getting trapped. Low 2 on 67, but small signal bar and weak. Bad context is what I mean. It's probably buyers below. Outside up, 68, probably going higher, probably testing higher in the range. The bulls may even get a measured move up to here. And if you get a double bottom, that brings you up here. And then bull surprise 69. Any surprise is always a leg 1, and you expect a second leg. Do you really want to sell the close of bar 69, betting it's a wedge? Probably not. Usually there's going to be a credible stop order. It's better to wait for that. Follow through 70. So really, the bears not getting what they need. There's a rally, trend line break, looking for a weak retest, and they didn't get it. This was a weak retest. We had a rally, trend line break, but then the retest was strong, and then a weak pullback, overlapping bars, 3 legs down, and then another fairly strong rally. This could easily go for this measured move. High 1, 60, bar 70, or bar 71. Bear bar, probably sellers above, but probably going higher for a second leg. And then there's your high 1 with a stop order above 72. Not ideal to be buying there, but I still think it's okay. We'll probably go at least a little higher. 73 a bull breakout, but now 2 legs up, 2 legs up, 1 pullback, 2 legs up. Several ways to look at it as a couple legs up, high in a range. I think the odds are. Plus it's bar 73. Now I think what I mean by it's bar 73 is it's late in the day. The market will do lower probability things later in the day. But we're close enough to that leg 2 measured move. We'll probably get there. We got there on 74, but then reversed. Sell signal bar on 74. It's a bull close, but it closed below its midpoint. and it looks like we're getting exhausted bulls because they know they're buying late. And there's a good amount of overlap today at the bull channel. Bear bar closing below its midpoint. Okay to get out of longs below 75. Probably sellers above 75. Bad high one. We trade above, triggering the high one. Probably sellers on the close of 77. 78 went sideways. We're in a trading range. Probably sellers above. And then 79. Bear bar closing on its low. Second entry short. Probably get out of longs if you're not already. And then just sideways into the close there. For always in, I think maybe bar 14 made it always in long. The context wasn't great, but it was a tight bull channel, and this stretch of bars here was decent. The bull bodies got bigger. We had bull bar closing on its high. We had little overlap, and price moved pretty fair distance. Always in long, but then you get 24, 25. That wasn't enough to flip the always in, but it was enough to get out of longs and look to buy again above a bull bar, closing above its midpoint. Maybe 33, maybe 40, maybe over here, 48. I'm not sure if we ever went always in short. Maybe we did briefly here. This was a strong enough leg one. It was probably going to get a second leg, but it was minor. And then in here, it's buy low, sell high, but with a bullish bias. So probably always in long in here. 48, I thought that was an always in flip. Okay to buy above 48 and hold long. Get out below a bear bar, closing below its midpoint here or here. But again, this was not enough to flip the always in, so it's still always in long. If you did get out of longs, you get a bull bar closing on its high, 64. You buy again, and you hold until there's a reason to exit. 3 pushes up, maybe you exit, I don't know, somewhere up here. As far as stop orders, well, because it was a lot of overlap today, there's not that many stop order trades. I thought the first credible one was probably above bar 12 or 13. Starting to get momentum up with trap traders below. It's probably going at least a little higher. I thought 24 was a good sell. And I thought traders would buy above 48, maybe buy above 50, 51. Buy above 64. You can sell below 62, but you really need a good follow-through bar, and you didn't get it, 63. So that was disappointing, and that's why 64 everybody bought. And then you can buy above 64 on a stop. You can buy above 68 on a stop. 72 is a high one. Some traders will buy, but the context is not great. For limit orders, I thought there were buyers below 3. Buyers below 6 never triggered. Sellers above 9, they got trapped. Sellers above 15, sellers above 16, those didn't trigger right away. But they did over here, and there were sellers above, but they came in later. Sellers above any of these bars, but it's a micro channel, and they didn't get triggered till over here. And then buyers, once you get maybe 2 or 3 legs down, there's buyers below, and there were buyers below on 45. I thought sellers above 52, but they may not come in until the high of the day, which they did. Sellers above the high one, 56. Buyers below 61. Buyers below 66. And then I thought buyers below 74. And then sellers up here above 74. We didn't quite get there. And again, as always, if anyone has any questions, please drop them in the comments and I'll get back to you as soon as possible. Hope everyone has a good night. Thank you for watching.